All right, let's get started. Today we're going to tear down a document that a lot of people just see as a simple pass-fail grade for a company, the auditor's report. But here's the thing, it is so much more than that. It's actually a really detailed narrative, a professional judgment, and, if you know how to read it, it tells you a fascinating story about a company's financial health. So let's just dive right in.
So what are we really looking at here? I mean, beyond that final thumbs up or thumbs down, what's hiding in the specific wording, the structure, and all the different sections of this pretty formal document? Well, that's exactly what we're going to break down, piece by piece.
So this really shows you the whole process in a nutshell. You've got the overall reporting function, which splits into two things, that formal independent auditor's report we're focused on, and then also communicating with those charged with governance, the board. But the whole thing, all the checks and balances, it all leads to this one final document. It's the grand finale after weeks, maybe even months of an auditor digging through a company's books.
To really wrap our heads around this, we're going to follow a really clear roadmap. First up, we'll look at the anatomy of a perfect, squeaky clean report. Then, we'll get into the juicy stuff, what happens when auditors actually find problems. After that, we'll break down the full spectrum of opinions they can give, and finally, we'll learn how to read between the lines to spot the things that really matter.
Okay, let's kick things off with the best-case scenario. This is what every single company out there is hoping for, an unmodified opinion. Just think of it as a clean bill of health. It's the auditor basically saying, yep, we've checked everything and it all looks good.
A standard, unmodified report has a super clear structure and it's always the same. It starts with a title, and that title has to say Independent Auditor's Report. Then it's addressed to someone, usually the shareholders. After that, you get to the core. The opinion section, the basis for that opinion, a whole part that lays out the responsibilities of both management and the auditor, and finally, the signature and the date. Every single piece is there for a specific legal and informational reason.
And right here, this is the money phrase. This is the whole point. The entire audit process is designed to get the auditor to a place where they can state, in their professional opinion, that the financial statements give a true and fair view. Or you might see, present fairly in all material respects. It just means the company followed the rules, the numbers are solid, and they've disclosed everything they're supposed to. But of course, life isn't always perfect, right? So what happens when an auditor can't give that clean opinion? Well, this is where we get into what's called a modified opinion. And honestly, this is where the real detective work begins for anyone trying to understand a company.
Look, a modified opinion almost always boils down to one of two fundamental problems. On one side, you have a material misstatement. In plain English, that just means the financial statements are wrong in a way that's big enough to matter. On the other side, you've got an inability to get enough evidence. Now, this is different. The auditor isn't saying the numbers are wrong, they're saying they just couldn't get the proof they needed to say they're right. It's a subtle but absolutely crucial distinction.
Now, before we go any further, there's a key word we have to nail down: pervasive. This isn't just about how big a dollar amount is. A problem is pervasive if it's not just stuck in one little area, or if it makes up a huge chunk of the financials, or, and this is the big one, if it's so fundamental that it makes the entire set of financial statements totally unreliable. It's kind of like the difference between a leaky faucet in the bathroom and a crack in the foundation of the whole house.
So here's how it all comes together. This is the decision grid the auditor uses. You take the two ideas, the type of problem and whether it's pervasive, and you get your answer. So follow along with me. First row, there's a misstatement, it's material, but it's not pervasive. The result, a qualified opinion. But if that same misstatement is also pervasive, it gets escalated to an adverse opinion. Now look at the second row. If the auditor can't get evidence and the issue is material but not pervasive, it's also a qualified opinion. But if that lack of evidence is so big that it's pervasive, they've got no choice. They have to issue a disclaimer of opinion.
Okay, so let's break down what these three modified opinions, qualified, adverse, and disclaimer, are actually telling you when you see one.
First up, we've got the qualified opinion. This is the least severe of the bunch. The magic words you're looking for are except for. The auditor is pretty much saying, hey, everything here looks good and gives a true and fair view, except for this one specific thing we're about to tell you about.
So, when do they use it? Well, a qualified opinion flags an issue that's big enough to mention, it's material, but it's contained. It's an isolated problem. The key takeaway for you, the reader, is that even with this one specific problem, you can still rely on the rest of the financial statements.
Next up, the adverse opinion. Now, this is the most serious criticism an auditor can possibly give. There's no except for here. The language is blunt. It says the financial statements do not give a true and fair view, period. This is a massive flashing red light.
An adverse opinion only comes out when the auditor finds a misstatement that is both material and pervasive. For example, say a company is clearly about to go bankrupt. It's not a going concern, but it prepares its financial statements as if everything is fine. That's a fundamental problem that makes the whole document misleading. Basically, an adverse opinion is the auditor telling you, do not trust these numbers.
And finally, we have the most dramatic situation of all, the disclaimer of opinion. In this case, the auditors don't say the statements are right or wrong. They say, we can't tell you. They literally say, we do not express an opinion.
A disclaimer happens when the auditor just couldn't get enough evidence to form an opinion, and the potential impact of what they couldn't see is both material and pervasive. So imagine a huge fire destroyed all of a company's inventory records, and inventory is a massive part of their business. The auditors can't verify it. They have to just throw their hands up and issue a disclaimer saying their work was so limited, they simply can't form a conclusion.
So we've covered the different opinions, but the story doesn't stop there. Even in a report with a totally clean, unmodified opinion, there are some special sections you absolutely have to look for. This is where you really learn to read between the lines.
If you're looking at a publicly traded company, you have to find this section called Key Audit Matters, or KAMs. This is basically where the auditor tells you about the things that kept them up at night. These are the areas with the highest risk, the most complexity, or the ones that required the most significant judgment calls. It gives you an incredible peek behind the curtain at the company's biggest pressure points. And let's look at a quick example of how this works. Say a company rolled out a brand new website that's tied into their finance system. The auditor flags this as a risk area, specifically around making sure all the revenue is being recorded correctly. The KAM section then walks you through exactly what the auditor did to check it. They learned the new system, they tested the controls, they did detailed testing. It's like a mini diary of the audit itself.
And finally, even with a clean opinion, you might see these special paragraphs called emphasis of matter or material uncertainty related to going concern. Now, these don't change the opinion. It's still clean, but it's the auditor's way of grabbing a giant highlighter and pointing to a specific note in the financial statements. They're telling you, hey, pay attention to this. It could be a huge lawsuit, a major catastrophe, or, most importantly, serious doubts about whether the company will even be in business a year from now.
So, as you can see, an auditor's report is a far cry from a simple stamp of approval. It's a complex, structured story that's jammed-packed with clues about a company's health, its risks, and its integrity. It's not just a grade, it's a narrative. So the real question is, now that you've got the tools, are you ready to read it?